The basics of interest rate risk in Asset-Liability Management, ALM. Asset-Liability Management, ALM, is an essential practice for financial institutions, ensuring that the management of assets and liabilities is done in a way that mitigates risks, including interest rate risk. Understanding interest rate risk. Interest rate risk is the potential for investment losses due to changes in interest rates. For banks and financial institutions, this can affect the value of assets and liabilities, ultimately impacting profitability. Types of interest rate risk. Repricing risk occurs when the interest rates of assets and liabilities reprice or mature at different times. Yield curve risk arises from changes in the shape of the yield curve, which affects the spread between short-term and long-term interest rates. Basis risk happens when the interest rates of different financial instruments or markets do not move consistently. Optionality risk associated with financial instruments that have embedded options, such as callable bonds, where changes in interest rates can affect the value and behavior of these options. Strategies for managing interest rate risk. Financial institutions utilize various strategies to manage and mitigate interest rate risk. Gap analysis. Gap analysis involves calculating the difference between the volume of rate-sensitive assets and rate-sensitive liabilities over specific time periods. A positive gap indicates that assets are more sensitive to changes in interest rates than liabilities, potentially leading to higher income in rising rate environments, but also to higher risk. Conversely, a negative gap suggests higher risk in declining rate environments. Duration analysis. Duration analysis measures the sensitivity of the price of bonds and other fixed income assets to changes in interest rates. Managing the duration of assets and liabilities can help in immunizing the portfolio against interest rate movements. Matching the duration of assets and liabilities helps in minimizing the impact of interest rate changes on the equity of the institution. Interest rate swaps. Interest rate swaps involve exchanging fixed rate payments for floating rate payments between two parties. This can be used to adjust the interest rate exposure of the institution's assets and liabilities. For example, if an institution has more fixed rate assets than liabilities, it might enter into a swap to pay fixed and receive floating to balance its interest rate risk exposure. Forward rate agreements, FRAs, and futures. Forward rate agreements and futures contracts allow institutions to lock in interest rates for future dates, providing a hedge against potential interest rate movements. These instruments can be used to manage the risk associated with forecasted borrowing or lending needs. Importance of interest rate risk management in ALM. Effective interest rate risk management is vital for the financial health of institutions. It ensures that the impact of interest rate fluctuations on net interest income and the economic value of the institution is minimized. The institution remains compliant with regulatory requirements concerning interest rate risk. The institution can maintain an optimal balance between its return on investments and the risk associated with those investments. In conclusion, interest rate risk in ALM represents a critical component that financial institutions must manage to safeguard their financial stability and profitability. Through a combination of gap analysis, duration management, and the use of derivatives like swaps and futures, institutions can effectively mitigate the adverse effects of interest rate movements. Remember, while interest rate risk is a significant concern, it's one part of the broader ALM process that includes liquidity risk, market risk, operational risk, and credit risk management. Want to learn more? Claire Trithel on LinkedIn.